which hyperinflated, but everybody had a bank account. So the hyperinflation occurred through the banking system. So the U.S. is headed for an Argentine-style hyperinflation, and I think we're actually getting pretty close. But what's happening is these green bars in the background is the U.S. government debt is growing now at such a rate that the U.S. government is borrowing more money than the market is willing or able to lend to it, which means that to get the dollars it needs, it has to either it has to stop spending or go to the central bank. And the central bank will either say, you've run out of money and we're not going to print, or they're going to print. And central banks always say, okay, we're going to print. And that's exactly what's happening in the United States. And look at this. It's not just the U.S., because that chart is similar to charts of a lot of other governments around the world. This is gold prices in 4 currencies. This is a base 100 analysis going back to 2000. And you can see here that this is a log scale chart. So the distance between 100 and 200 is the same between 200 and 400. So basically what it's saying is that it's very easy to look when the price of something doubles. Now over this period of time, past 11 years or so, 12 years, we're actually getting a parabola forming. So this is not a linear pattern that's developing, it's an exponential pattern. And this type of pattern is what you see as you're moving toward hyperinflation. So to me, the fact that we're in this parabola forming, we're getting closer and closer to hyperinflation. And I think you're going to see that at least $8,000 gold price before 2013 and 2015, as I projected back in 2003. And I want to explain why I'm actually thinking that price is going to be low. Aside from the fact that we're on this hyperinflationary road, I want to show you a very objective way to look at the value of gold, so that you take the emotion out of it and you just look at the numbers. This is the actual price of gold going back to 1960. And what I'm going to show you here is what I call the gold money index. And I'm going to lay across that what I call the fair value. I'll show you in a minute the actual formula. It's basically taking central bank gold reserves, dividing it by the gold in central banks, and coming up with a fair value. Now the interesting thing is that, back in 1960s, the dollar was as good as gold. The US dollar was as good as gold because the actual price, $35, was above the fair value. So everybody wanted to own dollars back then, but you can see, because of the debasement policies being pursued by the federal government, the fair value started rising and eventually got above the actual value until we got to number 2, where the actual price went above the fair price. That was 1974. You then had the setback in the actual price of gold, and it went back below fair value until January 1980, when you had the actual price once again above the fair price. Now look what's been happening over the past 20-odd years or so. You've got the actual price very far below the fair value. Now, there are only 2 possible conclusions from this chart. One is that gold is very, very undervalued and represents an asset that you should be accumulating, which is my basic premise and has been my premise for over 10 years now. Or gold is no longer money and no longer has any utility. But all of the other previous charts and slides that I showed you sort of suggest that that possibility cannot be real. So we're only left with one alternative, and that's that the price of gold is very, very undervalued. And what we should be doing in order to protect our wealth is to just continue accumulating physical gold, and if you're so inclined, physical silver, if you're prepared to accept the volatility, so that come what may, you know that you're preserving your purchasing power by accumulating a tangible asset that doesn't have counterparty risk. So because gold is money, we all, what you're doing when you're accumulating, you're basically saving money. We all know that savings are important. We have to save for the rainy day, we have to accumulate capital, and the best way to do it right now, because gold is so undervalued, is to accumulate gold, and if you're so inclined, accumulate silver. But remember, there's the physical gold and there's paper gold. Paper gold is a financial asset. It's based on someone's promise and comes with counterparty risk. Even the ETFs are paper gold in the sense that you don't own gold, you own shares in a fund that's supposedly backed by gold. But physical gold is something entirely different. Physical gold is a tangible asset. It doesn't have counterparty risk. And in this environment where financial uncertainty, banking problems, and currency crises are likely to get worse in the year ahead, you definitely want to own those metals. Now, talking about the year ahead, if you've heard some of my recent forecasts on King World News and elsewhere, my view has been, since the beginning of the year, that the low for both gold and silver was formed for the first week of January. As we get further and further away from those low prices, the probability increases that is indeed the low. And I'm suggesting that's low because of the keen level of undervaluation that we're seeing in the metals, and that we're going to head for much higher prices. Of course, we can't predict the future. All we can basically do is do our analysis and make some suggestions as to what we think is likely to happen. And what I think is likely to happen is you're going to see gold over $2,000 sometime in the first half of this year. And I would not be surprised, given that exponential chart that we saw on gold and foreign currencies, I wouldn't be surprised if we get up close to $3,000 sometime this year in the price of gold. And with regard to silver, we almost touched $50 back in April of 2011. And my guess is that we're going to take out $50 sometime in the first half of this year. When we, to be a little bit more specific, it's forming what I think is a very nice base and a very nice pattern. When we take out $45 on silver, you're probably going to see $70 within 2 or 3 months of that event. So I'm looking for something for $70, perhaps even higher, as we move toward the course of this year. So ladies and gentlemen, I've got 3 minutes. I'm happy to take any questions that you may have. Just shout so that I can hear you, because there's a lot of voices and stuff. Yes?
So your storage program, you're currently storing in Hong Kong, Zurich, and London, right?
Yeah.
Now, why don't you offer storage in Canada?
Yes, a good question. Questions about my company, Gold Money, which offers storage in London, Zurich, and Hong Kong. Why don't we store in Canada? It's simply because we haven't gotten around to it. We've been in business for 11 years. We're safeguarding $2 billion of assets. But there are 2 countries which our customers have requested, 3 actually, which we will be adding in the not-too-distant future. Canada, Australia, and the 3rd country, interestingly enough, is Dubai. People see it as a different political system, and therefore, in order to get geographic diversification, they see that as a country as well. So there will be something in Canada, and hopefully it will be this year, but I can't promise that because it depends on all of the priorities that we have in the company. But it will happen.
Here?
Yeah, someone else? Any other?
Here?
Oh, this way, okay.
When we see gold at 8,000, will that be hyperinflation? I ask that because in Zimbabwe it was 60 trillion amounts in 2009.
Yeah, if we see hyperinflation, all bets are off. It could be 800,000 an ounce. I'm just using this 8,000 to 11,000 forecast as an indication to show how undervalued gold is. And I brought up the hyperinflation issue because I see that as a real possibility. Yeah.
Yeah, what are the risks to your gold and silver forecast for 2012?
What are the risks to
your forecast for the gold and silver for 2012?
Well, the risk is I could be completely wrong.
And what would cause you to be completely wrong for 2012?
Well, it's hard to say what would cause me to be wrong. It depends a lot on investor sentiment, psychology, and how people see things. But the point I'm making with this presentation is that when you're buying gold and buying silver, you're buying an undervalued asset. And one thing I've learned over the years in my 40-plus years experience is that sometimes you have to be very, very patient. The markets never make it easy for you. But rarely do you go wrong when you're purchasing or accumulating an undervalued asset, which is another reason why I suggest using a dollar cost averaging program, because when you do that, you take a lot of the risks out of it. One last question, then I have to go.
Sorry if I missed it, but how did you calculate fair value on that previous chart?
Yeah, I think maybe I skipped through that chart accidentally. There's no reverse on this, but basically, it's take central bank gold reserves in the world, bring it to the numerator as the dollar, and then divide that by ounces of gold. So you get dollar per ounce price, and it's approximately 11,500. If you want to go to the Gold Money site, I think I have an article there. There's also an article on King World News using that formula to show the calculations. Ladies and gentlemen, it's been a real pleasure. I hope you found this helpful. Thank you for coming.